It's Brian Preston, the Money Guy.
Okay, Brian, here's a question from Braden. Braden says, as financial foo mutants, my wife is 26 and I am 29, have decided to put down 3 to 5% on our first home despite having 20%. And we're thinking about shoving the difference into a Roth IRA. Is this a good idea? So Braden has said, you know what? We were saving and we did it and we got to 20%. But I've listened to your show and I've heard you say maybe it doesn't make sense to put 20%. Since I got it, should I do it or should I just do the 3 to 5? And then follow-up question, if I don't do it, well, should I keep that money like in cash reserves or should I like dump that into a Roth IRA?
Yeah, so I mean, once again, this is why this serves you so well, the financial order of operations. I want you to go download the free deliverable. And then if you want even a deeper dive, Braden, I want you to go to learn.moneyguy.com where the course will be that you can pay to go even deeper into it. But yes, I mean, this is brilliant that you're a foo. You said foo, but here we are with the question, financial mutant, is that, yeah, I want you, because Roth IRAs, they are so powerful. Tax-free growth, and they also limit your income that you can make these contributions. And based upon you're a 20-something, I bet your income's on the rise. Mm-hmm. And there's going to come a time where you go, man, we don't get to do Roth contributions. It's even got to the point where potentially they're taking away backdoor Roth contributions. They're taking away the mega Roths. I mean, so if they're taking away some of these Roth benefits, it has to be because these things are super powerful. Don't miss out on that. You will have plenty of opportunity, especially with the low interest mortgage debt. I think we're all going to look back and we go, man, can you believe back in 2021, you could get mortgages at 2.5%. It's
going to be the lowest rate.
People are going to look back and be like, oh man, that just seems, when people are paying 6% or 7% or 8% in the future, they're going to be like, I wish I could get a 2.5% mortgage. And you're going to think about the Roth IRA that's still in the background working for you. And you still have the opportunity with financial order of operations. I'm not saying that you have to wait until you're an older person in your 40s. You might be 32 years old and you've already gone through the 8 steps. You've already got, hyperaccumulation, which is the 3 buckets. You got step 8 where you've got your kiddos, you're starting to do their college savings, and you might still have money on top of that to, that powder money that's in the background. At that point, if you've done all the other steps of the financial order operations, you can go knock out the 2.5% interest rate. It's not a maximization strategy. Mm-hmm. It's more of a strategy that you've done everything else. You're not worried about the maximization. You're now thinking about the risk element of it. That's why, and this is so important for me to share for people who are brand new to the Money Guy Show, the reason I put a differentiation at age 45 on prepaying mortgage debt is very important because from years 20 to 45, every dollar has huge potential. Mm-hmm. If you go look at what the multiplier effect of what compounding interest can do for you for every dollar invested, post 45, you're now, instead of maximizing your money, you're trying to think about risk, simplifying your life. That's why it's not a one-size-fits-all advice structure. We make it a little more nuanced, and that does add complexity, but it's done so you can put yourself in the right stage. Am I growing my wealth or am I preserving my wealth? There is a tremendous difference between those two, and we want to help you develop both skill sets.
Now, here's what you can't do. Let's say that you and your spouse were building up to this 20%, and the reason you would pick that 20% down on the house that you want to buy is because you liked what the mortgage payment was, right? The more you put down, the lower your mortgage payment is. Here's what you can't do. You can't only put down that 3.5% to 5% if it's going to drive your monthly housing costs above 25% of your gross income. You want to make sure that so much as you can control, you keep all of your housing costs below 25%. So that way you make sure you are in a healthy cash flow situation when it comes to housing. Because the last thing you want to do, put down 3%, have a really expensive mortgage, and then something happens. You lose a job, you have a health, whatever that thing may be, and all of a sudden, like, oh, wow, man, we can't afford our mortgage payment now. So it's okay to do this, to be a financial mutant, to take advantage of that, to grow the Roth and all those things, so long as you're staying inside the guardrails of making sure that it's still a solid purchase decision.